topic focuses on valuation and hedging using binomial tree models. Binomial trees provide a structured and visual framework for valuing derivatives, fixed income instruments, and securities with embedded options. The topic emphasizes that tree models simplify complex valuation problems by modeling multiple future price paths over discrete time periods. These models are widely used because they help investors understand risk-neutral pricing, option valuation, interest rate dynamics, and hedging relationships. Compared with closed-form valuation formulas, binomial trees offer greater flexibility for analyzing securities with early exercise features, changing interest rates, or embedded optionality. The program also highlights the usefulness of tree models within spreadsheet analysis and financial risk management applications. The topic begins with one-period binomial trees and the concept of risk-neutral modeling. In a one-period tree, an underlying asset is assumed to move to one of two possible future values, an upward state or a downward state. Under a risk-neutral valuation, expected returns are adjusted so that all assets grow at the risk-free rate rather than their actual expected return. This framework allows derivative pricing without directly estimating investor risk preferences. The program explains that risk-neutral probabilities simplify valuation because discounted expected payoffs can be calculated consistently across securities. Important concepts include P-measures, Q-measures, default risk premiums, and the components required for constructing risk-neutral valuation models within discrete-time financial frameworks. The topic then extends the analysis to multi-period binomial trees, which allow valuation across multiple time intervals and more realistic market scenarios. Multi-period trees create a sequence of potential future states that evolve over time, enabling investors to model dynamic price changes, option exercise opportunities, and changing interest rates. The program explains backward induction, a process in which values are calculated starting from final payoffs and moving backward through the tree to determine present value. Multi-period models are especially useful for valuing American-style options because they permit early exercise analysis at every node. Mean reversion, volatility assumptions, and probability adjustments also play important roles in determining valuation outcomes within multi-period interest rate and asset pricing models. A major application discussed in the topic is the valuation of convertible securities using binomial tree models. Convertible bonds contain both debt and equity-like features because investors can convert the bond into shares of the issuing company under specified conditions. The program explains that binomial trees effectively capture the hybrid nature of convertibles by modeling both fixed income cash flows and equity conversion opportunities simultaneously. Factors affecting convertible valuation include interest rates, credit risk, stock price volatility, conversion ratios, and embedded call provisions. Tree models also allow analysts to evaluate optimal conversion strategies under varying market conditions. Because convertible securities contain embedded options, traditional bond valuation approaches alone are insufficient for accurately assessing their market value and risk characteristics. The topic also examines callable bond valuation using binomial interest rate trees. Callable bonds provide issuers with the right to redeem debt before maturity, typically when interest rates decline. This embedded option reduces bond value from the investor's perspective because issuers are likely to refinance debt at lower borrowing costs when market rates fall. Binomial interest rate trees model future rate paths and allow investors to evaluate the likelihood and impact of call exercise decisions. The program emphasizes backward induction techniques for calculating callable bond values by comparing continuation values with potential call prices at each node. Interest rate volatility, yield curve assumptions, and issuer exercise behavior all significantly influence callable bond pricing and associated interest rate risk exposures. The program concludes by highlighting the visualization benefits and spreadsheet applications of binomial tree models. Tree structures provide intuitive visual representations of uncertainty, future states, and valuation paths, making them valuable educational and analytical tools. Spreadsheet implementations allow analysts to perform scenario analysis, sensitivity testing, and dynamic hedging calculations efficiently. Binomial trees are especially useful for securities containing complex features that cannot easily be valued using simpler formulas. The topic also stresses that although tree models simplify financial valuation problems, their accuracy depends heavily on assumptions regarding volatility, probabilities, default risk, and interest rate dynamics. Consequently, investors must combine quantitative modeling with sound judgment and careful interpretation when applying binomial tree methods in practice.